Hi everyone, great to see you back from the break. I am Johan Wilsby. I joined Kindred as the CFO back in late 2020 after spending more than 20 years in various tech companies, amongst them Microsoft and Hewlett-Packard. I am here today to talk to you around how we run the business and how we drive shareholder value. My first 18 months with the company have certainly been exciting, provided me with quite a bit of insights and learnings. Obviously enjoying last year with some tremendous growth and some all-time high results, and then the last few quarters of some curveballs in some of our key markets. Despite these temporary headwinds, I think it's fair to say that the main pillars of the strategic plan we put in place a couple of years back has been validated to a great extent. Yes, some changing realities have provided us with additional insights so we can refine planning, and that includes our journey back to expected profitability. So today I'm going to start out and give you an overview of some key metrics on our performance. I'll address the current financial year. Then we're going to move on to some focus areas and look at some of our investments, look at some key elements of those business cases, and also how they will contribute to further scalability and profitability. Then it's time for outlook and guidance section before we wrap it up, and I'll give some color around M&A and capital allocation. As you can see in the metrics here, we have had a consistent track record of growth while many of our countries have gone through regulation. We've grown faster than the market, and we have a diversified revenue base. We have achieved that by growing organically as well as adding acquisition. We did 7 of them in this period. Nils earlier talked to some strong market positions, and outside or on top of the market growth, we have outgrown the market by 4 points, and all of that has been leading up to a revenue CAGR of 18% the last 5 years. From a profitability perspective, we've grown the EBITDA margin by 3 points, and that's a combination of driving efficiencies across the P&L while also seeing betting duties increasing materially since many of our countries have gone through regulation. At the end of 2021, almost 80% of our gross winnings revenue came from locally regulated markets, and that's up around 40 points the last 5 years. From a cash flow perspective, we have seen solid cash flow conversion, and we've used that to reinvest in the business, to do M&A, and to return capital to shareholders. In total, we've returned more than 500 million to shareholders in the form of dividends and buybacks. Henrik talked earlier about our journey towards a regulated market portfolio. And on that journey, it is critical to scale in everything we do. When I joined the company, it was evident that we had a cost optimization framework in place for major areas like bonus, marketing, commissions, and operating expenses. And I think it's fair to say it was even more evident from 2019 and forward. As you can see here, we have seen major efficiencies in the areas of like bonus and marketing. And within the OPEX efficiency numbers here, we see some of the scalability efforts that Marcus talked about. For example, one of our important metrics is lights on spend per transaction from tech, and that's down 50% over the last few years. Scalability is a key pillar of our strategic plan, and my strategy as the new CFO is to drive scalability in all aspects of the company. That means continuing to develop and accelerate the optimization framework and invest in future levels of scalability. I think that's what's going to move the needle in terms of margin expansion, in addition to having a highly scalable Relax on board. In summary, I think we have sufficient scale to compete well in the online market, and we have the building blocks in place to drive further scalability in the next 3 to 4 years. Let's now turn to the current financial year, and I think it's fair to say that our financial performance has been lagging expectations. As you see to the left, we've seen our top line decline quite a bit due to factors like the cessation of our Dutch services and some temporary headwinds in other key markets. Then you couple that with pretty tough comparatives from 21 with COVID tailwinds, as well as having the Euro 2020 Championship lost first half. In the bridge here, you can see some estimates around these factors, and one of them that I want to discuss is obviously coming back to what Neil talked about, the sustainability one, which is obviously driven by increased affordability requirements in the UK and a couple of other markets. And this impact will increase in H2 as we are accelerating our internal measures around affordability. You see COVID normalization and other macro impacts, as well as the core impact of being out of the Dutch market. Given first half, it's fair to say that 22 is a bit of a lost year from a profitability perspective, but being back in Netherlands means rapid improvement. In parallel to the Dutch exit in Q4, we accelerated our optimization efforts, and these will contribute now as our top line will come back. As communicated earlier, we have continued to invest in selective areas like tech, responsible gambling, our North American expansion, as well as our in-house sportsbook that you heard Ben talk about. I really look forward to a continued strong comeback now in Netherlands and continued good, strong, solid execution in the core markets, and that will mark the start of our way back to expected profitability. So let's now move to one of our focus areas and start with the Dutch market. After being awarded the license in July and going live we were awarded the license in June, right, AJ? We went live in July. We have had a great start the first couple of months. As AJ talked about, we have daily gross winnings revenues of above 300K and increasing, and we have more than 100,000 active customers. We see evidence of strong brand equity in Netherlands. In fact, we've only been spending about a third of our marketing plan, which obviously leads to positive EBITDA results from day one. The market is estimated to almost double, or it's 70% actually, and that gives us a strong position to grow back share from. And in fact, the Dutch market is going to be a bigger market for us in the future than what it used to be. We expect to grow into top 3 position already this year and end the year with an estimated 15% market share. Beyond this year, we expect to be a market leader, as AJ talked about, and we expect to see material contribution already next year from the market. So let's now move to Relax. Relax was founded 12 years ago, and Kindred joined as a major shareholder in a couple of the early financing rounds. As Simon talked about earlier, the team built and developed the business model, the tech stack, and products with a great sense of quality. In parallel to the product milestones, moving from bingo poker, aggregation, into their own casino games, the company has seen an exponential growth of number of operators with Relax. And both of these two have resulted in very high growth. Relax joined Kindred back in Q4 of 2020, and it's been a great collaboration between the teams through a limited integration effort because we want them to continue to operate as an independent and attractive B2B player. It's great to see how the platform, the foundation that the team put in place has now become a platform for scalability, like similar to other B2B peers. Relax enjoys about a 90% gross margins, and I don't expect the operating expenses to grow that much. On top of the core B2B performance, we have identified a plan of synergies, and we see annual synergies a couple of years out of around 7 million, mainly driving traffic towards relaxed games and aggregation. In summary, I'm certainly very excited about this acquisition and what we can do together in the future, Simon. So let's now talk about our in-house sportsbook. As Eric and Ben talked about, we have the strategic plan putting products and customer experience first that we believe will bring long-term value to the group, and where the sportsbook is a key element, right? From a strategic perspective, we will see increased differentiation, agility, and mitigation of risks. It's an advantage for us not to have a lot of legacy systems to align to. Instead, we can embrace the latest development of technology when it comes to machine learning, algo for decision making, or automation. And I actually think that will drive true differentiation and customer value. As you heard from Ben, the racing platform was always built with sports in mind. And on that base, we started to invest in the sportsbook in late 2020. The total cost for the sportsbook will peak next year in 23. And from 24 and onwards, it will level out and start to decline. We estimate that the rollout phase is going to be between 2 to 3 years. And we will see some financial benefit in the P&L already in 24 and 25. After full implementation of the in-house sportsbook, we expect our total cost for the sports betting business to decrease by 30%, which means that the profit margin for the sports betting business is going to be increased by north of 500 basis points. At the group level, this means margin expansions of above 200 basis points at the EBIT level. This is a material improvement and one of the core drivers behind our in-house sportsbook investment. We're essentially moving some of the B2B margins to us as an operator while capturing strategic values that I discussed earlier. So time to discuss our North American plan. I think it's fair to say that the initial phases of the North American online market have been characterized by excessive levels of investments and lack of profit pools. We still think that underlying trends like product excellence and customer centricity will apply to these markets as well. We believe that our niche strategy and somewhat different approach is not only what will pay off in the long run, but will actually protect our balance sheet in the short term. Our ambition is to be a top 10 operator in markets where we have market access. This is a long-term plan, and we're laying the foundation right now with, for example, rolling out the platform, as you heard Marcus talked about. Our roadmap to profitability in the region is 2026. This is later than other operators, but we always assumed with a more limited upfront investment, it would take us longer time. We're balancing the aggregate of losses versus time to profitability, and we're managing that through annual losses while we're laying the foundation for long-term success. We're continuously reviewing performance and the plan in the region, and we will continue to optimize our state footprint in line with the strategy to my right here. To complement our organic business plan in the region, we will focus more on finding partnerships and potential M&A opportunities that will fit our portfolio of states and provinces. And this is similar to what we've done in some of our other key markets. So let's now move our focus to the outlook section and start with the market opportunity. As you've heard during the afternoon, Kindred has contributed to the overall market growth in the online space, and we've been consistently gaining share. We believe this will continue and obviously underpinned by a general digital transformation of societies. And this will provide us ample growth opportunity in our core markets, plus North America as an opportunity. The overall TAM is above 50 million, as you see here, and that is a TAM or a CAGR of 10% the next 5 years. Our short-term focus is to excel our performance in these markets and have limited focus on opening up other markets across the world. As Nils said, we believe that we have enough growth opportunity in our portfolio markets, and we'll do that through organic growth combined with potential M&A in the next couple of years. So it's now time to present a summary of our value creation plan. Earlier, I've addressed areas like our ability to drive performance, how we optimize our P&L, and how we invest in focus areas. And here I've tried to add them together to illustrate our value creation drivers. We recognize that macro environment changes can obviously impact our estimates. We have considered those and some specific topics around our sector that we can predict. In first half of this year, you've heard us say that we expect us to be back at a long-term average of profitability in 2 to 3 years. And what's going to take us there is the market growth, share gains, as we discussed in the previous slide, and then a strong comeback in Netherlands, continuously adding cost efficiencies, and having a highly scalable Relax on board. All these factors will take us to expected levels. Beyond this milestone, we see further margin expansion, and that's mainly through our investments in tech, and specifically in our InHouse Sportsbook, and also our North American expansion going to maturity. We estimate that these will lead to even more attractive levels in the medium term. So let's move from a visual to be a bit more concrete. As you might have seen in the press release this morning, our board has decided to establish financial targets for the full year of 25. Those are total revenues measured on an organic basis above 1.6 billion, obviously built on continued market growth, share gains. We have also built in compliance and affordability measures into these. An overall solid CAGR for that revenue of 14% compared to last 12 months, June 22. From a profitability perspective, we put out an EBITDA margin range of 21 to 22% for 25. In absolute terms, this will mean record high profits for the company. Obviously, behind this are the drivers in my previous slides, and please note that the full benefits of our in-house sportsbook investment will come beyond this horizon. Our board also made a decision to revise our distribution policy to now be 75 to 100% of free cash flow after M&A, from the previous policy that was 75% over time. We estimate CapEx in relation to revenues to remain fairly stable, and by 2025 we expect the share of our gross winnings revenues to come from locally regulated markets to be around 90%. As we announced this morning in the trading update, Q3 has started out well. Our daily average revenues are 2.9 million, still declining 12%, but if you exclude Netherlands from that, we actually see solid growth now. Our long-term sports margin are roughly on the same for the quarter, and obviously the trading in the regulated market in Netherlands have started out really well. Based on that quarter-to-date performance, we have today issued guidance for Q3 of total revenues between 270 and 280 million, and an underlying EBITDA range between 37 and 42 million. So let's now move to my last section around capital allocation and M&A. Obviously an important area for everybody in the room, and my intent is to give you some insights into our priorities for decision making around capital allocation. With several changes in our regulatory environments the last couple of years, we have prioritized high financial flexibility and low financial risk, i.e. no net debt. We have used a strong balance sheet to reinvest in strategic themes and done selective M&As. As Henrik said earlier in his introduction, having an active M&A agenda has been instrumental for our growth in our portfolio, with examples like BetChoice, Stan James, 32 Red, and recently Relax. Our corporate team or corporate dev team's focus is on bolt-on acquisitions to strengthen current market positions, to complement our organic plan in the North America region by finding partnerships and M&A opportunities. And as we're focused on products and tech, we also look in the emerging tech space and also for additional B2B opportunities. We have a strong balance sheet, and we have also debt facilities ready to put behind these M&A ambitions. Today we have no debt, but in the future, with a more regulated business which carry lower risks, we don't rule out that we will increase debt financing. Obviously, we will evaluate this over time, and that will depend on macro development as well as M&A opportunities. As I mentioned earlier, our distribution policy today is to provide stable annual dividends complemented by buybacks and overall distribute 75 to 100% of free cash flow after M&A. With this, let me try to bring it all together for you. I hope I've been able to share some insights around how we manage execution and drive performance in the company, how we optimize and drive efficiencies both short-term and long-term, and how we invest in focus areas, and that we have a clear plan getting back to solid profitability. All of this execution is part of the strategic plan we put in place a couple of years back, which has the focus of growing in regulated markets, lowering the risk with a base on trust and customer experience.